Wall Street just dropped its biggest forecast of the decade. Multiple major banks, including Deutsche Bank and JPMorgan, are calling for the S&P 500 to hit an astounding 8,000 by the end of 2026. This isn't just optimism, it's a massive bet that the AI boom, combined with a crucial policy shift from the Federal Reserve, is about to send the stock market into a historic surge. The median target is already high, with firms like HSBC and JPMorgan setting their base calls at 7,500. But the extreme upside is where the action is. Deutsche Bank is leading the pack, officially setting its 2026 target at 8,000, calling for mid-teens returns. Morgan Stanley and Wells Fargo are also firmly in the bull camp, forecasting 7,800. This bullishness is built on a simple foundation. Corporate earnings are exploding. The S&P 500 saw earnings growth of 13.4% in the third quarter alone, proving that companies are converting the AI investment cycle into real profits. The roadmap to 8,000 requires two things to break right. First, the AI supercycle must accelerate. JPMorgan argues that current elevated valuations are actually correctly anticipating above-trend earnings growth for the next 2 years, projecting a 13% to 15% increase. They believe the productivity gains from AI and deregulation are still being massively underappreciated. Second, we need the Federal Reserve. Markets are now pricing in an 83% chance of a Fed rate cut at their December meeting. JPMorgan sees this as the ultimate lever. If improving inflation prompts the Fed to cut rates more aggressively, it unlocks the path for the S&P 500 to surge past 8,000. But this aggressive boom isn't happening in a vacuum. Underneath this incredible market strength is a systemic risk that banks are now calling out, the K-shaped economy. This means the economy is splitting. The wealthy haves, who own stocks and assets, are benefiting massively from the AI boom and soaring markets. The have-nots, or lower-income consumers, are struggling under pressure. Wells Fargo and JPMorgan both warn that the AI boom is amplifying this polarization. The danger? Equity gains are now so tied to household wealth that a bear market could trigger an economic downturn the government and the Fed absolutely cannot afford leading into an election cycle. So, here is the crossroads. Wall Street is betting on a powerful two-stage rally, a reflation hope phase leading to an AI-driven surge. They see the momentum, the earnings, and the policy support lined up for a run to 8,000. But the price of this growth is an increasingly fragile and polarized economy. If the AI boom turns into a bubble, or if the economic divide snaps, the downside risk is massive. The AI-driven bull market has room to run, but investors must remember that the higher the market climbs, the greater the exposure to that dangerous K-shaped economic foundation. Do you agree with the 8,000 forecast, or is the K-shaped economy too big a risk? Let me know your thoughts in the comments below. Don't forget to subscribe for more updates.